Gentlemen, we have Fed Jerome Powell coming tomorrow in the most important Fed meeting that people are calling for in over 40 years, because this time is different. And I know that is a really bad saying to use, but typically when there's banking crises and banks are going bankrupt like 2008, the Fed was in a position to cut rates. This time around, they are not. So the Fed really has to say some very specific things, or all hell could break loose. And we're going to get into the hellish outcome that could potentially come tomorrow, and a more dovish outcome, and talk about what is likely, what the markets are pricing in, where the markets could go, what could happen with AMC, all of that good stuff, guys. So we are going to get into it. Let's do it. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. So right here says the Fed is likely to hike rates by a quarter point, but it must also reassure it can contain a banking crisis. Now, you also had Janet Yellen that spoke today, and ironically enough, do you guys know the scene from The Big Short where the hedge fund guys, I can't even think of their names, they go to the conference with all of the major bankers, and the guy from The Office, I literally cannot think of his name right now, he makes the scene in front of everybody, basically. That same conference in the movie is the same conference Janet Yellen spoke at today. Pretty ironic. Well, she read off of a script the whole time, from the first statement through the questions they were asked. It was all pre-prepped. She read off a script, and you could tell she was kind of nervous. She wasn't trying to say any slight word that would misconstrue what she was trying to say. She didn't spitball any questions like Fed Jerome Powell will do when he gets on the podium. So that's kind of showing how fragile the system is right now. The markets actually did take a dip off of that, a pretty substantial dip, when she was speaking, likely because it was so scripted. It was stupid, right? You've never seen that scripted, and that's because there's so much instability in the system right now. And that's the wild part about all of this, is you've never had a banking crisis at the same time you've had 6% inflation, at least not in modern history. After 08, or even during 08, inflation was not a problem then. Federal funds rate was 5%. They just cut rates. When banks started to fail, they cut rates. That's what Fed Jerome Powell should be able to do right now. He's obviously not able to do that. So on one hand, it's a lose-lose all the way around. If you raise rates 25 basis points, then you look like you're just neglecting this banking crisis. The crisis might get worse and ultimately push us into a deeper and longer recession. If you don't raise rates, then you're showing your hand to the markets that this might be a lot worse than we expect. And about 90 days after that, you could expect the first rate cut as far as history is concerned. And that's also not a good thing, because when central bankers freak out, that's typically when you should freak out as investors. So there's really not a clean-cut bullish outcome here. Now, what would be bullish, in my opinion, if they string this needle, which I don't really think is likely, if Fed Jerome Powell comes out tomorrow, and keep in mind this will be at 2 p.m., you'll get this statement, you'll get the summary of economic projections, we'll talk about that in a second, and then you'll get the press conference at 2:30. Most bullish outcome tomorrow is if the Fed raises rates by 25 basis points, says inflation looks like it's easing, we still have more work to do, the economy looks fine, the banking system looks fine. If there were a problem, then we would step in and make sure everything was fine. That's probably the best case scenario for the markets tomorrow. But still, they're still raising rates in a financial crisis. Either way, hopefully you guys can see, it's not really a bullish outcome coming. And last we heard from Fed Jerome Powell, they were thinking about raising rates more aggressive. So I find it hard to think that he goes from saying maybe we're going to get 50 basis points, or what's the language he used? additional rate hikes that essentially were not forecasted, right? Increasing the pace of rate hikes and then coming out tomorrow and saying everything's fine, inflation looks like it's going away, does not look likely. That's why I put the best case scenario as probably the least likely scenario, because inflation is still very high, and even the data we got today is very inflationary. Home sales spike 14.5% in February. That's not a good thing. That's the one sector the Fed is really trying to combat right now. It's about 1/3 of the CPI report, and doesn't look like it's going down, especially from these numbers that we got today. Markets initially went up off of this because it shows the consumer might be okay. They're still looking to buy houses. They still have some money. But then the market subsequently fell because we realized, hey, this is not good for fighting inflation. So not really a good outcome potentially tomorrow. The markets, I will say though, they want to be bullish. The markets are currently up about 1% across the board. Actually, the Dow is up 0.5%, S&P up almost 1%, NASDAQ up over 1% at 1.10%, the Russell 2000 up almost 2%. So the markets want to be bullish. The VIX is down 10.5% today. That's a very big move down on the VIX. Also, considering you're having such a bullish day today, maybe it sets you up for a little bit more downside coming tomorrow. But I think the markets are really going to be concerned with the banking crisis, and there's going to be a lot of questions that are asked about it. At the same time as we have a banking crisis, you're also seeing the yield curve, which is uninverting. Now, it's inverting a little bit more today, which is actually a bullish thing, believe that or not, when the 2-year and 10-year yield curve is inverted. That's telling you that 2-year bonds are paying you out more than 10-year bonds, which is not a bullish thing in the grand scope of what could happen in the economy, right? That's not necessarily a good thing. But compared to the alternative, it's a pretty good thing. Because when 2-year yields go higher and this inversion deepens, it's showing you that markets are not that concerned about a recession, because recessions bring deflation. So why would a 2-year bond go up if you were expecting a recession, expecting deflation? It wouldn't happen, right? When the 2-year yield starts to drop and the 10-year remains pretty stable like what we've seen, or even go higher, that's where you get the inversion that starts to uninvert. And that's what has happened as of recently. March 8th, you were inverted about 1.10 basis points, 1.10% essentially. And then now you're only inverted by 0.59 basis points. So you have seen a steepening. You're falling a little bit today. You really want to see this fall again, because his history shows us that when this uninverts, that's where the pain actually happens, and that's where you can expect a recession within the next 3 months. So we'll see. I think that will be important. Now, as of currently, the time of recording this video, the 25 basis point rate hike is almost priced in with certainty. 88.6% chance of a 25 basis point rate hike, 11.5% chance of a pause. Whatever is over 50% coming tomorrow, the Fed is going to do. So unless something drastic happens overnight today, like First Republic were to go bankrupt or something else crazy like that, a real black swan event or gray swan event, then you're going to get a 25 basis point rate hike. At least that will be solidified. The commentary will be the most important thing. On top of that, the Fed balance sheet has went into quantitative easing mode, and meaning the balance sheet has went up by over $300 billion just within the last week or two here. And that's going to be a big question, especially reporters at 2:30 have for Fed Jerome Powell. That will be very important, because most of the time throughout history, when the balance sheet goes down, that's not necessarily a good thing as far as interest rate policies. When the balance sheet goes up, typically that means a cut is coming or some kind of easing of financial conditions. So not necessarily a good thing. You have not seen the balance sheet go up really at all over ever since the Fed really started fighting inflation and doing quantitative tightening in April of 2022. So it's been a while since we have seen this, and especially to see a jump this large is not really a positive thing. And I think the Fed's really going to have to explain themselves and exactly what they are doing to investors. So there you have that. This is all going to be very important. Now, you're also going to get a summary of economic projections coming out at 2:30 as well. And that's where the head Fed members of their districts, right? Atlanta Fed, San Francisco Fed, New York Fed, Philly Fed, they come out and they plot where they think interest rates are going to go, where they think GDP is going to go, where they think inflation is going to go over the course of the next 1 to 2 years, right? And the markets are going to pay very close attention to what changed from the December summary of economic projections, because if you get a big change there, if either the Fed members expect lower GDP or even maybe a recession, or Fed members expect higher inflation or higher federal funds rates, that's not going to be a good thing compared to the narrative that we have gotten as of lately. The markets are still expecting 1 to 2 rate cuts by the end of 2023. The Fed has said over and over again, you're not getting rate cuts in 2023. That's really going to be put to the test now that banks are going under. So if you can't tell, there's a lot of potential bad news. Like I said, the markets want to be bullish, so I wouldn't hang my hat on that. But what this could ultimately mean for AMC could be a very dramatic response from either a bullish or bearish response in the markets. If the markets are bearish tomorrow, doesn't necessarily mean AMC has to fall, but it typically does fall on bearish Fed days. Typically everything falls on these very bearish Fed days. Now, very bullish Fed days, you could easily see AMC up 10%, 15% tomorrow, because it is one of the more risk on assets. At the same time as this, I do expect some kind of new analyst commentary around this litigation coming April 27th. We have not gotten any new updates or any new opinions or thought pieces on this, and that's really, I think, what investors are waiting for with AMC. We want more opinions on how this court date is going to go. If anyone has more insider information, that's also something investors in AMC want to see. And when I say investors, it's really the algorithms that would control that move. Once you get doubt around the court date April 27th, you're going to have a lot more room to rally to the upside. I'm not going to forecast that's going to come out tomorrow, but I do think by the end of this week we'll get some new bit of information. If not this week, next week for sure. If we take a look at the live short interest for AMC, that is sitting at 24.21%, 125.02 million shares that are currently sold short. Cost to borrow rates, I think that is really the standout data point for the day. Cost to borrow average at 337.5%, cost to borrow max at 359%, cost to borrow minimum at 7.6%. Taking a look at Interactive Brokers, cost bar rates 196.5%, with about 400,000 shares that are currently available to be lent out. These rates just continue to go higher. It's honestly a little crazy at this point. You would have expected by March 14th AMC's cost to borrow rates to fall off after that. That's not exactly what is happening. Now, on the day today, you are above the long-term resistance level. This has been the line in which pretty much every rally has got rejected at. You're now above that. That's a very bullish thing. And now that we're above this, we can really start to look ahead to where we could go next. And we do have to break out above 450. If you break out above the 450 resistance level, then you really have a gap from 450 up to about 550, and that's going to be the trading range that we're probably in throughout the rest of this week. I don't really expect a lot of downside from here. You can see you're in a bottoming formation, and you did break above this line that I just mentioned. At the same time, you've seen a lot of pain recently for AMC. I think it is drastically overblown compared to the litigation process that we are about to see, which could take months and months and months, even though fundamentally that could squeeze shorts out of their short positions given a couple month time frame. In the short term, it's all going to be dominated, I should say the price action will be dominated on opinions and thought pieces around this litigation. Now, if we take a look at the S&P 500, if Fed Jerome Powell is negative tomorrow, guys, the recent lows that we have seen is about 379. That could be where we could approach very quickly. Tomorrow, you could even break to 385. That would be kind of my expectation if it is bearish and if the markets don't like what they hear. That would be a drop of about 3% coming tomorrow. I think that is very much on the table, as well as a rally to potentially 410. That would be a 3.5% move to the upside. The market makers are pricing in a $6 move on the S&P 500 itself, which would put you about a 1.5% up or down move coming tomorrow. So that's the implied volatility from the options market on the SPY. So if you break down from here, that's not going to be a good thing, but you really have to get under the prior lows that we just hit around 379 to even start looking bearish, or that you're going into another bearish downtrend. You've now been in a bullish uptrend for so long now, really ever since about January 26th, that the markets want to be bullish here. But again, Fed policy is going to dictate valuations. It's going to dictate when a recession is going to happen, how deep a recession might ultimately be. So that's why Fed Jerome Powell is going to be very exciting tomorrow. For today and after hours, though, you have GameStop, Nike, and Array Technologies. GameStop, that's going to obviously be big for the quote-unquote meme stocks. Nike is going to be big for the state of the consumer. If Nike has bad earnings, it's not going to be good for, again, the odds of a recession. The ultimate thing the markets care about is a recession. The whole reason we sold off in 2022 is ultimately because when the Fed raises rates, 95% of the time, it leads to a recession. That's what the markets are ultimately most fearful about. So, yeah, Nike earnings will be important. If people are not buying as many products, not going to be a good thing. GameStop can move AMC as well. I don't think if GameStop drops, though, AMC has to fall. I think you could have a much more positive relationship than that. If GameStop does go higher, AMC would likely go higher as well, guys. So that is going to do it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for watching, and I will see you in the next one.